Okay, and this is the first order. So Telly Limited is a business selling televisions. They buy TVs on credit from a supplier, Samsung. They've returned the TV as it's damaged. Write down the source document, book a prime entry, debit and credit. Well, source document. If I return something because it's damaged and it was bought on credit, I get the credit note, and it's me that receives it, so credit note received. The book a prime entry. Well, I made a purchase and I've returned it. So it's purchases, returns, journal, debit and the credit. Well, one must be purchase returns, obviously, and the other one will be my supplier, Samsung, not bank. There's nothing linked to the bank, look, it's all on credit. So purchases is a debit, so purchase return is a credit. And my debit is Samsung is the supplier, so that's a liability. So the rule for liability is credit if it increases, debit if it decreases. So I'm going to owe Samsung less, it's decreasing, so debit. Okay, next one. Television Limited has 60,000 issued share capital from £1.25 ordinary shares. So straight away, work out how many shares by dividing. So it's 64,000 shares and 40,000 share premium. I don't need to know that in a minute. They pay dividends at 4p to each shareholder. So that's how many shares I have, times by 4p. 2,560. So therefore, my retained earnings goes down by £2,560. Next one. Return on capital employed. So the formula is operating profit divided by capital employed. And capital employed is my non-current liabilities plus my equity. So operating profit was 30,000 divided by capital employed. So I need to add together my debentures, so that's a non-current liability, plus my issued share capital, that's equity, plus my share premium, because that's equity, plus my retained earnings, that's equity. You get 170,000 times by 100, so and 2 decimal places, so 17.65%. Okay, fourth one, Telly Limited has realised that the sales count is £100 overcast. So the error is addition. They've added up the sales count incorrectly. So what it looks like, so for sales, it looks like it's on the credit side, it's X plus 100. I want to get rid of the 100, so I want to put 100 on the debit side. So I'm going to debit sales by 100. It's my general journal. So therefore, my credit must be suspensive. And last one, Telly Limited bought their property for £800,000. They depreciated by 20% per annum using the reducing balance method. After 3 years, it is revalued at £850,000 was its revaluation surplus. So get the net book value after 3 years times by 0.8 to the power 3, or you could work out the depreciation each year by times by 20%, take it away, times by 20%, take it away, times by 20%, take it away. I'm just doing a quick method. Remember, it's like compound interest at GCC. So we get 409,600, and it's now been revalued as this. So I take away the net book value, then not the cost value, the net book value. It's always handy if your calculator's got an answer button on it. And there we go. The surplus is £440,400.